what will happen when certain costs occur over time, or when certain profits or benefits only start to happen in year 2, 3 or 4. To calculate this, we use the payback period. And in this lesson, I'll show you 2 ways to calculate the payback period. First of all, the simple payback period, and second, a model that we'll use in Excel to see how we can calculate and incorporate changing cost and changing benefits over time. This is the formula for the simple payback period. The formula says that the simple payback period is your project cost minus your initial return divided by your yearly benefits minus your yearly expenses, your OPEX, operational expenses. First of all, it takes your project costs minus your initial return. When you start a project and you have initial cost, there's also a chance that you have initial returns. Now, the initial returns are subtracted from the project cost, and that's when you end up with the total cost that still needs to be repaid. And that number is divided by your yearly benefits minus your yearly expenses. And that makes sense. If you have yearly benefits of $1,000 and you have yearly expenses of about $500, then each year you earn back $500. So then your project cost minus your initial return will be divided by the income you get from the project. So say the project costs $1,000, that's project cost minus initial return, and you divide it by the $500 that comes in every single year, then it takes you 2 years to pay it back. That's the formula for the simple payback period. As I already said, there's a more complicated way to calculate the payback period. For example, when you have certain costs that start to occur over time. Now here's an overview of how you can calculate the payback period. This is the top column, and I'll color it. This is the bottom part, the real information. As you can see, it holds the year, the project cost, operational cost, benefits, cash flow and cumulative value. We have year 0 till year 6. Now, our training vendor says what we see is that in the first year we usually have 30% effectiveness, but then in the second and the third year we are 100% effective in reaching our goals, and then in the fourth and fifth year it starts to dwindle. 6th year we have no effect at all. If your training vendor is that precise in the numbers, start working with them. Estimating the benefit is usually something that takes practice, that you can learn from by looking at other companies. A while ago I spoke with someone and they had an absenteeism of around 2%, just below 2% last year. And their big thing was they compensated everyone for every 3 months with no absence. Employees got €50. And when they were not absent for a full year, they received an additional €50. So every year they could earn €250, it was in the Netherlands, by showing up at work. And that was for them a really effective intervention. So that's an intervention with quite low project cost probably. We know the project cost in this intervention and we know the operational costs in this intervention. The benefits we have estimated to be 40k, 125k in year 2 and 3. In year 4 and 5, 75k, 25k, and then in the 6th year there's no effect at all. Big question is, how do we now calculate the payback period? We do this using the following formulas. First of all, we need to calculate the cash flow. Now the cash flow is your operational cost, so I say equal C3, plus your benefits. So in year 1, you'll find out that the cash flow is, and I'll make the column slightly wider, negative. It's negative 132k. Now, if I apply this formula to the other fields, you see that in the second year we have no cost and benefits of 125k, so the cash flow is also 125k, and it keeps following the benefits simply because we don't have any operational cost. Say we have in the second year $50,000 in operational cost, you see that the cash flow changes. Anyway, I'll remove the operational cost over here. Big question is, what is the cumulative value? The cumulative value is the cumulative cash flow including the project cost. So in the first year we say the project cost is minus 30k plus our cash flow, which is minus 132k, so that will be minus 162,000 US dollars. In the second year we take the cash flow, so equal cash flow first year, we take the cash flow from the first year and we say do it plus the cash flow in the second year. And I say enter. And this is a formula that we can extend. Now what does this mean? In the first year we have a cumulative value of minus 162. In the second year we're at minus 37,000 US dollars. And then in the third year we're net positive. The big question is, how do we now calculate the payback period? We do this by taking the minus 37k. And why do we take this number? Because we know that somewhere between the second and the third year we hit 0. It goes from negative to positive. So we take this number and we divide it by the cash flow in the next year, which is 125,000 US dollars, and we divide it by 365 days in the year. If I now hit enter, it does F4 divided by, between brackets, E5 divided by 365. It says we have 108 days. It will take us 108 days. Let's leave out the 0.4. It will take us 2 years and 108 days before the benefits outweigh the cost. This is our break-even point. We should even be able to put this in a line graph. How we do this is we plot a line. We say select the data. This is our data. So we see that the line somewhere in year 2 crosses the break-even point where the profits start to outweigh the cost. So if we would take the 0 line as a break-even point, and I can plot a second line where we actually have a break-even point. So I say select the data, select this data. As you can see, the break-even point is at 2 I don't know the exact number, 2 years and 108 days. That's the break-even point, that's the payback period. Now don't worry if this all went just a little bit too quickly. I just wanted to show you the break-even point as it's a way of visualizing the process that you just went through. You can calculate the payback period using the simple payback period function, using the payback period function that we just did in Excel. But I also wanted to show you the visual way of doing this, which is the break-even point, and some consider this an alternative way of calculating the payback period. But it's basically just a visual representation of what we just did. So to put it in nice slides, it will look like this. Our cash flow is our operational cost plus our benefits. And the payback period will take 2 years and about 108 days. Why? Because that's 37,000 US dollars divided by the cash flow of the next year divided by 365, which is again 2 years and 108 days. Now what have you learned? First of all, you need to define a project and make sure it's relevant for the business, it's relevant to achieve your HR outcomes. Now second, you need to list the activities and define their cost. That's the principle of activity-based costing. You have a number of activities and you can define their cost. Third, you need to estimate the project benefits using, on the one hand, literature, on the other hand, talking to the vendors, and also by just testing it. And as part of this, you need to define the duration of the benefits, and you need to define when the benefits start to occur and when they'll stop to be active. Fourth, you need to calculate your ROI. And fifth, you need to calculate a payback period. This really is the basis of financial HR. And it's important that this is absolutely not an exact science. This is a rule of thumb. When you try to make a business case for a senior manager, latch onto the key benefit that it provides. You say, hey, we have a problem on, in this case, absenteeism, and we need to fix it. That's the mission of the board, and that's also what we're going to do. Now, that's by far the strongest argument. Second, you can say, hey, we also ran the numbers, we estimate this impact. That's your second argument. So when you make the business case, start with the relevant business question, say you can solve it, and that's usually the best starting point. But financial HR and activity-based costing can act as a way to make your argument even stronger.